Good day, everyone, and welcome to our webinar for August 2024. We start as usual in America. What happened in American politics over the last month has been just quite remarkable and unprecedented. Beginning with Joe Biden's resignation, which in our opinion was the essence of statesmanship. He voluntarily gave up his chance for power to make way for Harris, and this is clearly something that Donald Trump would never be able to do. The unexpected move has given the Democrats a strong advantage. Harris is now leading in most polls and has raised more than $310 million in less than 2 weeks. We now expect that she will beat Trump, and that will be the end of Trump, most probably. US elections very seldom have much impact on equity markets, on the share market. Over a different administration, there can be some gradual effects, but there's generally no short-term impact. A second Trump presidency would mean more protectionism and isolationism, and over time that would be negative for the stock market. Equally, a Harris administration is likely to see more business as usual, and we think that that would generally be good for the stock market, but the impact of presidential elections in America is not that much. South Africa, of course, might suffer a little bit because of our affiliation with the BRICS countries, but I think that in either presidency, we will almost certainly be part of the African Growth and Act, which is part of, the AGOA Act, which is part of the American situation, which benefits South Africa. All right, let's look a little bit at the economy. The Federal Reserve Bank left interest rates unchanged at their meeting, and they encouraged the idea that rates will be cut from September. Powell said that the usual indicators of recession, like the SARM rule and also the yield inversion, were not giving accurate predictions of what would happen in the economy. He said somewhat cryptically, history doesn't repeat itself, it rhymes. Not quite sure what he meant by that. But his comments caused a one-day surge of bullishness, which did not last. Our tweet on the 10th of July, some time ago, you see over here on the 10th of July on the chart, we made a tweet there, and we said in that tweet, some sort of correction is looking more and more likely. That's what we said there. And of course, if you look at the history of this chart of the S&P 500, you can see the cycle high at 5254, which established a support and resistance level at that line. There was a 5.5% correction, which took the market down to a low point of 4967. And on the way up, we had a very strong recovery. We had two corrections, but the bullishness in the market was so strong, and there was so much buying of the dip that there almost was no dip. In other words, the first and second correction in that upward trend were more or less just sections of flat market, where the market moved sideways for 2 weeks. So we really haven't had a major correction since the middle of April, and the market was very fully priced and really overdue for a correction. So that's why we made that tweet there on the 10th of July, and as you can see, the correction is now in full force. In the correction here, you can see where the market broke down over here on this day. And then there was what we call a dead cat bounce. In fact, there have been 2 dead cat bounces so far on this downward trend. And we called them as dead cat bounces. And then, of course, we had a shooting star over here. You see this shooting star formation where the upper shadow is twice as long as the body of the candle. That's called a shooting star, and it's generally a very negative candle. And that happened on the 25th of July. That was followed by a 1.8% fall on Friday, which was here. and then a 3% fall on Monday. And it appears that investors have suddenly become very concerned that the American economy is about to enter a recession. So there's been a big sell-off of shares, and the correction has really taken a hold on the market. And of course, the economic data was looking a little bit negative, no doubt about that. The ISM manufacturing index came in at 46.8, which was a bit worse than expected. The yield on the 10-year Treasury bill dropped below 4%. That was also unexpected. The U.S. economy only created 114,000 new jobs in July, which was well below estimates of 180,000, and of course well below the average for the year, which was 215,000. The unemployment rate ticked up to 4.3%, which triggered the SARM rule, which is an indicator of an impending recession. It's basically where the 3-month average of the jobless rate is 0.5% above the 12-month low. But in our view, none of those things are really strong enough to indicate that there is a recession taking place in America, or that there's likely to be one. We think that there might be a soft landing now, where growth is a little bit slower, but generally speaking, we're not looking at recessionary territory in America at all. One factor, of course, has been the unwinding of the Japanese carry trade. The carry trade occurs where you have an opportunity, or investors have an opportunity to exploit the difference between interest rates or returns in different countries. So Japan has had very, very low interest rates for a long time, nearly 20 years, almost zero. Interest rates have been down at 0% there. So it's been possible to borrow money in Japan very cheaply and then invest it into US Treasury bills and get 4%, right? Or some other investment like equities in America and get a higher return. So investors have been doing that. It's been a virtually risk-free trade, and it's been going on for quite a long time, as I say, more than a decade. Now suddenly the Japanese government has pushed interest rates up slightly. First they started off with a 0.1% increase in interest rates and then a 0.25% increase. This has resulted in a reversal of a lot of those carry trade positions, and that has resulted in a sell-off of equities and something of an undoing of that huge carry trade position, and that is part of what is going on here. The Japanese Nikkei index has fallen 9.2% since its peak of 12.7. Its peak on the 12th of July this year, but it's fallen nearly 10%. All right, so now we have to consider whether with this downward trend that we are looking at here, which has included some quite sharp falls, breakaway gap over here, really strong fall here, 3% fall, followed by a 1% rebound yesterday. Is this the start of a bear trend? That is really the critical question. In our view, it is not. In our view, this is an overdue correction in an overbought market, and it is basically healthy. We do not believe that this is a bear trend. The market just went up too far, too fast, and now it has corrected. So as we said, that is healthy. We continue to believe that the great bull trend which began in March 2009 is still in place, and it will continue, and that therefore in time the S&P will recover and go on to make some new record highs. The PE on the S&P 500 is now 24.44. At the top of this trend here, at the peak here, at the high, the S&P was at 5667. That was the highest close. And then it had a PE of around 27. Now it's fallen back to about 24.4, which is still historically high, but it can go much higher. In fact, in May 2009, we saw the PE on the S&P 500 reach over 120. We do not think that the impact of artificial intelligence, humanoid robots, and the switch over to renewable, mainly solar energy, is yet fully discounted into markets. We think that those trends have got a long way to go still and will have a big impact on profitability, especially among the S&P 500 companies. But what has happened reminds us always of the rule that nothing in the markets moves in a straight line. There will always be more corrections, and you should always be looking out for them. All right, so that's America. Obviously, we pay a lot of attention to America because our market tends to follow the Wall Street and go up when it goes up and go down when it goes down. Let's turn our attention now quickly to Ukraine. It is now 30 months since Russia invaded Ukraine. Putin has clearly not achieved any of his objectives, really. Russian propaganda is trying to say that their economy is still growing, but a recent article by 8 finance ministers from NATO countries says this is a lie. Rather, the plan that Putin is putting in place is to try and Sovietize Russia, turn it back into the Soviet Union of Soviet Socialist Republics, the USSR. And in doing so, he has shifted the economy onto a war footing with massive fiscal spending. The war effort is costing the country way too much in both men and material. There's a severe labor shortage inside Russia, which is pushing wages up, and the weakness of the ruble is also causing inflation to rise. Inflation, in fact, has more than doubled to 8.6% last month from last year's position of 3.3%. Russian export revenue has fallen by 1/3. The 14th sanctions package is targeting liquid natural gas, which is a huge export from Russia, and also their shadow fleet, which has been taking their exports around the world. So that's now being targeted by this 14th sanctions package. At the same time, the EU has given Ukraine a new loan of $50 billion, which will be financed by income from Russia's frozen assets. The flow of modern weapons into Ukraine is gaining momentum, including most recently F-16 fighter jets, which I think will make a huge difference to the Ukrainian war effort. Many analysts say that Russia is on the brink of collapse, both economically and militarily. Russia has made some small territorial gains, but at an unsustainable cost in our view. Both sides now seem to be moving towards some sort of peace talks, but of course the sticking point will be Ukraine's refusal to give up any territory. Russia also appears to be on the brink of losing Crimea, which must be a concern for Putin. Putin may be forced to negotiate by Russia's dire situation. Essentially, now that a Democrat victory in November is more likely, it's bad news for Putin. He was hoping that Trump would win and that would give him a respite. If the war does come to an end, if there is some kind of a settlement, it will be very good for share markets around the world, and also bad for gold. So just bear that in mind when you're thinking about your investment strategy. Okay, let's look at South Africa now. First, we start looking at political developments. The political risk in the share market has reduced substantially with the advent of the Government of National Unity. Markets have responded well, with equities and bonds looking better. There are, of course, still problems. The ANC and the DA have been political enemies for 30 years. So expecting them to work together without any problems is just naive. There is still a possibility that the ANC could break away from the DA and form an alliance with the EFF and MK. That is the potential risk to the rand and to the share market going forward. The hope is that Operation Vulindlela will bring massive reforms. It's already had a major impact, as we see in the electricity sector, but it should bring more reforms from there. And we hope that the economy will start to grow closer to its potential. The first cabinet meeting was a success, with President Ramaphosa said to be buoyant after the meeting. Apparently there was general agreement on what the problems were and how to solve them. Even the NHI was seen as practical with a few changes. The High Court, of course, had blocked the ANC's attempt to force doctors to work in specific areas. They wanted doctors to obtain what was called a certificate of needs. That has been thrown out by the court as being unconstitutional. It cannot force people to work in specific areas. That is one of our freedoms. The ANC is now complaining that the newly appointed DA ministers are making them look bad because they really are working hard. And on that subject, the DA Minister of Public Works, Dean McPherson, has, within the first few days of taking office, has reported a massive 300 million rand fraud, which has been going on in his department for 10 years. So that is extraordinary. And then the DA Minister of Home Affairs has vowed to eliminate all the backlogs, 300,000 applications, and he's going to eliminate that backlog. He's already made significant strides. South Africa remains at risk of losing its participation in America's African Growth and Opportunity Act, but our view is that that will not happen. If we do lose our position in AGOA, it will impact about 20% of our exports, to the US, which is about 2% of our total exports. So it's not that big of a deal, but it would be a negative, especially for the motor industry. We believe that America will keep South Africa in AGOA, whichever administration takes over in November, because the alternative would be to drive us further into the Russia-China camp, which they don't want. Foreign direct investment should improve with the new government of national unity, and that should be a positive factor for the South African economy going forward. All right, talking about the economy, as expected, the Monetary Policy Committee kept interest rates unchanged. Many economists said that rates should have actually come down, but the MPC wants to keep the rate differential with first world countries in place, because that obviously makes investing in South Africa far more attractive. Inflation is expected to fall to 4.5% by next year. That's the midpoint of the target range, and that will be a huge achievement. The Monetary Policy Committee is, in our opinion, correct to be conservative. South Africa has one of the lowest inflation rates of all emerging economies, and that has been a big benefit. I mean, for example, you can compare us to a Nigeria where inflation is above 34%. Low inflation in our economy has managed to keep us alive through the Zuma years. Zuma was never able to get control over the Reserve Bank. All right, the producer price index was steady at 4.6% in June, unchanged from May. It is averaging 4% this year, compared with 6.7% last year, which shows that the inflation rate is coming down. Low inflation encourages foreign direct investment, so it's always a good thing. The Bank of America says that South African economy will grow by 2% per annum for the next 3 years. And that's quite an increase. I mean, we haven't had 2% growth since 2013, so that is a big improvement. Mainly, of course, their prediction is based on the elimination of load shedding, but it will result, if they're right, it will result in greater tax collections and obviously in time a reduction in the national debt. The government is projecting that the debt will be 4.3% of GDP in 2024, falling to 3.9% in 2025. But the new cabinet is much bigger than the old one because there are more ministers. So it's now costing R1 billion per annum for all these ministers. A minister gets 2.58 million a year, deputies get 2.2. Stats SA says that the government spent about 2.2 trillion rand in the 2023 year, 2.04 trillion rand. Interest on the government debt grew by 15% to 308 billion rand per annum. Social grants accounted for 242 billion, and provincial governments got 694 billion. The high level of interest rates shows the danger of falling into a debt trap. So South Africa is highly indebted as a country. And obviously interest has to be paid on that debt. So when interest rates are high as they are now, there is the danger of a debt trap. The IMF says that South African economy will grow by 1% this year and 2.2% next year. The ABSA Purchasing Managers Index came in at 52.4 in July, which is sharply up from June's 45.7, and shows that the economy is actually growing, that the manufacturing sector is actually growing. This is mainly again due to the suspension of load shedding, and I think a rising optimism in business as a result of the GNU. Lower prices for petrol and diesel have also helped. BankServe's take-home pay index indicates that salaries were up 6% over last year. And because inflation was 5.3%, it means that real incomes went up by 7.7%. Consumers are still facing very high interest rates, but they should start to fall from about September, if not sooner. General dealers had a 2.9% increase in sales in May, and new car sales were up by 1.5% from June, so that's an improvement. Consumer confidence has improved, and I think that's because of the GNU and also the anticipation of lower interest rates coming. Mining production continues to decline, mainly due to lower commodity prices. Amplats, Sibanye and Implats have all retrenched staff and are closing shafts. Difficulties at South African ports continue to impact both imports and exports. Both fell by 8% in the first quarter of 2024. At the Durban port, only 7 of 16 ship-to-shore cranes are operational. So that gives you an idea of the problems they're facing. All right, a few general points now. Professor Francois Engelbrecht, who's a professor of climatology at Wits, says that the climate in South Africa, as a result of climate change, the climate in southern Africa will get much hotter. There will be more droughts and heat waves. This will undoubtedly negatively impact millions of subsistence farmers in South Africa who rely on a few acres of maize to give them enough food to feed their families. So this is a major factor for us. Second point, the illegal sales of cigarettes in South Africa cost the fiscus, the treasury, about 2 billion rand a month in lost taxes. British American Tobacco has asked for a minimum selling price to be set, where all retailers will have to sell cigarettes for a certain price or more, right? But not less. So that, because at the moment these illegal cigarettes are selling for a fraction of the price of the legal ones. So there's been a huge switch across to illegal cigarettes, especially following the restrictions in COVID. Illegal cigarettes, of course, have health hazards because they contain all sorts of nasty chemicals like lead, tar, cadmium, carbon monoxide, and so on. And they're completely uncontrolled. All right, most service delivery in South Africa is provided by our 257 municipalities. About half of them are under investigation by the Hawks for corruption. The result has been a very poor service delivery and rampant protest action. It's now proposed that some of these municipalities, the worst ones, are dissolved, that their councils are dissolved and that they are forced to hold new elections to appoint a new council. The South African Local Government Association, SALGA, is opposing that idea. The Government of National Unity is now toying with the idea of bringing back prescribed assets, the policy of prescribed assets. This is a policy that was first introduced by the National Party many years ago, and basically it forces the pension funds, unit trusts, and other institutions to invest in certain assets. They've got to invest a certain percentage of their money into government assets to promote growth, right? The problem is that these assets often do not generate a decent return. So the inevitable result is that returns on these pension funds and unit trusts and so on will be lower. And the idea is generally not a good one in our view. It's obviously opposed by pension funds because of the lower returns. All right, let's look at Eskom quickly. Friday the 5th of July, earlier last month, about a month ago, was the 100th day that South Africa was without load shedding. It heralds a new era of stronger economic growth and optimism. Many, of course, were disappointed by the reappointment of Gwede Mantashe as the Minister of Minerals and Energy, but it looks like he has been sidelined by the Minister of Electricity, who is Ramakopa. Mantashe is still a powerful force within the ANC, but his influence appears to be less. Bringing Unit 5 of Kusile power station online changes the energy availability factor substantially. That unit alone generates 800 megawatts of power, and obviously that has a big impact. Investec now estimates that gross domestic product will grow by 2.5% next year, and that will add 2.1 million new jobs. The ANC has been forced away from its socialist policies, and it has been forced to accept more private-public partnerships. Standard Bank says improvements at Eskom and Transnet will result in 3% GDP growth in the coming years. During the just for comparison, during the Mandela presidency, growth was 2.7%. During Mbeki's presidency, it was 4.1% on average, and with Zuma, it was only 1.5%. Ramaphosa's term obviously hasn't finished yet, but he has brought in some reforms which are definitely causing some improvements in the economy. Electricity production is moving rapidly towards renewables. The National Transmission Company began business on the 1st of July. They are the NTCSA, as it's known, and they will be investing in 14,000 kilometers of new transmission lines. Electricity is bought on the open market at competitive rates and then on-sold to consumers and businesses also at competitive rates. This should relieve the mining industry, which is struggling with high electricity costs. The Boston Consulting Group says that South Africa is still short of between 4 and 5 gigabytes of power, so there's lots of room for more renewable energy installations. All right, let's look at some commodity prices now. Just want to quickly look at the gold price. We've spoken about this in previous confidential reports, but what I just want to do is to show you this chart here, which you see on your screen. And here you can see there's COVID-19, and you can see that there was a definite resistance level at $2,060 per ounce. And then in the March confidential report, we drew your attention to the fact that gold had broken up through that resistance and that a new upward trend was probably in the offing. And as you can see, the new upward trend is definitely there, and gold is moving up very strongly. In fact, it reached a new all-time record high of $2,462 the other day. It's obviously boosted to some extent by heightened political risk. The assassination of Ismail Haniyeh by Israel, who was the leader of Hamas, obviously had an impact because it made the potential for a Middle East war more likely. So there you've got it. The gold price, gold shares have been moving up, and things like Krugerrands have done very well as well. Gold, remember, is the ultimate store of value. It doesn't pay any return. It doesn't pay you any interest, dividends, or any kind of return whatsoever. But it is very, very secure. And money that you put into gold will be protected against the weakness of paper currencies and other paper assets. All right, let's look at the oil price. We always look at the North Sea Brent oil because it's a very good benchmark. This is just a chart showing you what's happened in the oil price. Let's get a bit more data on the screen here. You can see that since the beginning of the year, the oil price was rising for the first 4 months, and then it went into a downward trend. We had a cycle low here at 77, and then the fear of a war between Israel and Iran helped to push it back up. It reached a high point here of about $87. That's where last month's confidential report was, there on the 4th of July. And since then, it's been falling quite steeply. Obviously, this last fall here is due to the collapse on Wall Street, the fall in the S&P 500, because, of course, if America is going into recession, then it's generally expected that the demand for oil will be lower. But that's taken the oil price down to $76. Obviously, a low oil price is very good for the Democrats in America, and it's very bad for Vladimir Putin. All right, let's look also then at Bitcoin, because we did talk about Bitcoin, and I think it's quite important to put some information on the screen here. All right, this is the Bitcoin chart here. You can see a while back, in fact, we tweeted over here on the 24th of May, quite a while ago, that the Bitcoin price had produced what we call a descending triple top. You can see the tops here. The first top was this one on the 14th of March. The second top, which was lower, came in here on the 8th of April. And now we've had a third top over here on the 5th of June. And as you can see, this is like a fourth top, which is also lower than the third top. And that top had a shooting star formation right at the peak here, and now has collapsed, as you can see. This is what we call an exhaustion gap here. And this, obviously, this upward trend is a bit of a bull trap. So what is going on here is, in our view, is that the smart money is getting out of Bitcoin. That is what is happening. And these are big players. They've got huge quantities of Bitcoin, and they're dumping it on the market. Anytime the market goes up and tries to break above these tops here, they're in and they're selling aggressively. And the result is that the Bitcoin market is drifting sideways and downwards, making successively lower tops, which is a very bearish signal from a technical point of view. Of course, Bitcoin cryptocurrencies have got no fundamentals, so the only way you can actually evaluate them is on the technicals. And you'll see here's the 200-day moving average, and Bitcoin is on the cusp of breaking below that critical technical level. All right, our advice remains, if you have Bitcoin, sell it. If you don't have it, don't buy it. That's our advice. And that advice has been very consistent for a long time. All right, let's turn our attention to the JSE and specific shares. I want to begin by just looking at the banking sector. I'm going to use the banks index. It's not a great index any longer, but this is where the Government of National Unity was agreed and accepted, and as you can see, it had a major positive impact on the banking sector, and that impact has continued. In fact, the banking sector is a sector that will benefit directly and immediately from the improved economy which is expected to result from the Government of National Unity. It means less loan defaults, it means more economic growth. Banking shares were trading on an average dividend yield of around 6 to 6.5% before the Government of National Unity. They're now trading on a dividend yield of 5.3%, but we still think that that's pretty good. Still looks like good value to us. Of course, the best of the banking shares has been Capitec. We'll just have a quick look at that. Okay, here's the Capitec share price. All right. Just want to... We added Capitec to the winning shares list on the 4th of November last year. So over here, there on that day there, in fact, the 4th of November. Yeah, so I mean, it was at about 185 Rand, 185.496 cents. It's risen very steadily and very strongly since we added it to the winning shares list. Now trading at about 278 Rand, 2,785 Rand per share. So it's gone up very, very strongly, gain of about 50% in 10 months. And remember that Capitec is a very, very risk-free investment. It's not a strong risk investment. Okay, let's have a look at some other shares. ArcelorMittal. This, of course, is South Africa's last remaining steel company. It is the survivor. All the other steel companies have collapsed, including Highveld Steel. You remember when that one failed. If we look at the chart, I want to just put 5 years data on here. What's interesting about this chart is how effective the 200-day moving average is. You can see I've put a 200-day moving average, gave a fantastic upside break here, buy signal over here. And then later in May of 2022, a very good sell signal here after making a double top. It's come all the way down here. Now it looks like after this island formation, which you see here, looks like there may be an upside break. But of course, don't forget that steel is a commodity. And like all commodities, it is subject to volatility. Okay, now I want to look at Curro. Curro is a provider of high-quality education in South Africa. It's a much-needed service, and it basically has grown because of it's taken advantage of the collapse of government education in this country. And you can see here there was a cycle low at 712 cents per share, and after that there's been a steady upward trend. We believe that Curro is a good share. It's good because it has very low working capital requirements. They don't have a lot of stock. They don't have debtors because the tradition in education is to pay for your education in advance. When you enroll your child at a school, you have to pay for the school fees in advance. And everybody does that. So they don't have debtors really, and they have very little stock, but they can still run their creditors out for 30, 60 or 90 days, so they have good working capital position. The only negative is that they do have to invest in schools. So they've got to buy schools and own them, and that is a large capital investment. In a trading statement for the last 6 months, the 6 months to the 30th of June, they estimated that their headline earnings per share would be up by between 10.9% and 21.3%. So the company is doing well. It's growing strongly. All right, next share I want to look at is Capreg. This is Capital and Regional. It's a property share which owns and manages in-town community centres in England. It's obviously a real estate investment trust, but in the UK. So it's a rand hedge. It's a good share. We added it to the winning shares list over here on the 29th of May, and it's gone up quite nicely. There it was at 14.79. It's now at about 16.50 last night. So it's also been acquired by Growthpoint. So you'll know Growthpoint is the largest property company in South Africa, and they paid 78 million British pounds to buy 51.2% of Capreg, and obviously that means they'll inject their management expertise, and it gives the share a good rand hedge position. All right, and then Bell. We did write an article about Bell, but I just want to mention it here. This offered a rare opportunity for private investors to make a nice windfall capital gain. We added Bell to the winning shares list over here on the 27th of October 2023 because we thought it was underpriced. We thought it was cheap, given its fundamentals and its profitability and so on. And we added it at 1875. They published their results for the 2023 year up to the 31st of December 2023 over here. And gradually the big institutions started to realize that this company was underpriced and cheap, and they started buying it up, and you can see the share price drifted up. And then over here, the Bell family announced that they wanted to buy out the minorities in this business. So they already have 70% of the company, and they want to buy out the other 30%, and they were willing to pay 53 Rand a share. So from that point there, where it was trading for about 31 Rand, it jumped to over 50 Rand a share. So if you took advantage of the fact that we added it to the winning shares list over here in October, by now you would have seen your money grow by 169%. And that happened in just 9 months. So it's been a real windfall share, that one. Another windfall has been Murray & Roberts. As I'm sure you're aware, construction companies in this country have been hammered, especially during the Zuma years. They were hammered really badly, and many of them went into liquidation. There were a few survivors. The survivors were forced to sell assets and pay their debt down and so forth. And Murray & Roberts was no exception. They also had to, rationalize and restructure with lower debt and sell off assets. But now they've gone through a long, as you say, I see an island formation here between September and December. And we decided that this share was cheap at these levels. We added it to the winning shares list on the 21st of December at 106 cents. And it closed last night at 289 cents. So it's gone up very, very nicely. Obviously, this is a company that could benefit very much from the new government of national unity and the public-private partnerships that are expected to flow from that. As I said, at the moment, 189 cents. If you bought it here at 106 cents, you would be up 178%. Again in 9 months, so it was a good one. Okay, folks, well, that's about all I have for you today. I hope that you found something in there that was of interest or of use to you. Remember that we will have another confidential report on the first Wednesday of next month. Until then, I'd just like to say thank you very much for listening to me, and I'll talk to you again soon.